Welcome, dear students and scholars. We begin ASC 260, earnings per share, with the big picture before we touch detailed calculations. EPS is one of those topics where the formula looks small, but the mistakes can grow very quickly if the structure is not clear. In this lesson, our goal is to build the map, what basic EPS means, why diluted EPS exists, who reports EPS, and where it appears in financial statements. Keep one simple idea in mind from the start. EPS connects earnings, common shareholders, and capital structure into one per share number. EPS matters because it turns total company earnings into a number attached to each common share. Investors look at it, analysts model it, and exams love testing it because it combines concepts and calculations. But EPS is not a magic health report for the whole company. It is a focused per share performance measure. A company may have rising net income, but if the share count rises faster, EPS may not improve. So, EPS is like a financial spotlight, useful, powerful, but not the entire stage. Here is the learning path for this first video. We will first understand what EPS measures, then who must report it under ASC 260, then how basic EPS and diluted EPS fit into the framework, and finally how EPS is presented. Later videos will slow down and isolate each calculation area. That matters because EPS becomes much easier when you do not mix everything together. First, build the filing cabinet, then put each rule into the right drawer. EPS answers one essential question: how much earnings belong to each common share? A helpful memory anchor is the earnings pie. The numerator is the earnings pool available to common shareholders, and the denominator is the number of common share slices sharing that pool. If either side is wrong, the final EPS is wrong. So, even though EPS may look like a simple division, the real skill is identifying the correct earnings and the correct share count before dividing. ASC 260 mainly applies to entities with common stock or potential common stock traded in a public market, and also to entities that are filing or are in the process of filing to sell those instruments publicly. This is why EPS is a public reporting topic. Investors need comparable per share information when shares are traded or about to be traded. The scope also includes potential common stock, such as options, warrants, and convertibles, because those instruments can affect diluted EPS later. For non public entities, the rule is different. They are generally not required to present EPS, but here is the important compliance point. If a non public entity voluntarily presents EPS in its financial statements, it must follow ASC 260. It cannot invent a shortcut formula or present a management style per share number as if it were US GAAP EPS. Once EPS is shown, the standard walks into the room and says, "Thank you, I will handle this from here." Now we come to the basic EPS formula. Basic EPS equals income available to common shareholders divided by weighted average common shares outstanding. In this video, treat this as a framework only. Do not worry yet about every preferred dividend rule or every share count timing rule. Those are coming in separate lessons. For now, remember that basic EPS uses the actual common share claim on earnings without assuming conversion or exercise of potential common shares. The numerator and denominator must stay separate in your mind. The numerator asks, whose earnings are we using? After preferred claims and other required adjustments, how much income belongs to common shareholders? The denominator asks how many common shares were actually outstanding, weighted for time. Many EPS errors happen because students move an income issue into the share count or a share count issue into income. EPS rewards clean thinking and punishes messy mixing. A simple capital structure means there are no instruments that could become common shares and dilute existing shareholders. In a simple structure, the company may have common stock and possibly non convertible senior securities, but no options, no warrants, no convertible debt, and no convertible preferred stock. In that situation, basic EPS is the relevant EPS measure. The exam shortcut is simple: scan the fact pattern for potential common shares. If there are none, do not create diluted EPS out of thin air. A complex capital structure includes instruments that are not common shares today but could become common shares later. Options, warrants, convertible debt, and convertible preferred stock are classic examples. If including those instruments would reduce EPS, they are dilutive, and diluted EPS must be presented. This is where ASC 260 becomes calculation heavy. But the idea is simple. Diluted EPS asks what the per share result would look like if potential common shares became real common shares. Basic EPS and diluted EPS should not be confused. Basic EPS uses actual weighted average common shares outstanding. Diluted EPS starts with basic EPS and then considers dilutive potential common shares. The numerator may also change for convertibles because interest or preferred dividends may be added back when conversion is assumed. One rule should stay locked in memory: diluted EPS should not be higher than basic EPS. If it is higher, you probably included something anti dilutive. EPS is also a presentation topic, not just a calculation topic. Public entities present EPS with high visibility on the income statement. Basic EPS and diluted EPS, when required, must be shown with equal prominence. EPS is also presented for all periods shown, so comparative statements require comparative EPS information. This matters because users do not want a hidden calculation. They want a clear per share result that can be compared across periods. When discontinued operations are reported, EPS presentation needs extra care. EPS from continuing operations is important because it focuses on ongoing business performance. Per share amounts related to discontinued operations also need to be shown or disclosed depending on the presentation approach. The key point is that EPS must reflect the income statement structure clearly. Students should not combine everything blindly if the question separates continuing operations and discontinued operations. Let us mark 4 traps now, even though we will solve them in later videos. First, using total net income blindly without checking preferred dividends. Second, ignoring preferred dividend claims. Third, confusing the basic EPS denominator with the diluted EPS denominator. Fourth, including anti-dilutive instruments just because they exist. These traps are common because EPS questions often look familiar at first. The danger is not that the formula is hard. The danger is answering too fast. Use this memory map as your anchor for the entire topic. ASC 260 has 5 major branches: scope, basic EPS, diluted EPS, presentation, and traps. When a question feels complicated, locate the branch first. Is the issue about who reports EPS? Is it a numerator issue, a denominator issue, a diluted EPS method, a presentation requirement? Once you know the branch, the problem becomes smaller. EPS is not one giant monster, it is several manageable doors. That completes the framework for ASC 260. In the next video, we focus only on the numerator of basic EPS, income available to common shareholders. We will look at net income, preferred dividends, cumulative preferred stock, and the exact amount that belongs in the top half of the formula. If this lesson helped you build the EPS map, please like the video, share it with your colleagues, subscribe to Commerce Regiment, and support the channel so we can keep building this US GAAP course with clarity and depth.